1. Elizabeth Warren vs. Private Equity in 401(k)s, What You Need to Know. 2. Trump's 401(k) private equity expansion, retirement game changer. 1. Elizabeth Warren vs. Private Equity in 401(k)s, What You Need to Know. A critical shift in how we think about our retirement savings is unfolding, and it's stirring up a storm of controversy. Imagine the possibility of investing your 401(k) in companies that aren't available on the public market. Traditionally, 401(k) plans have been limited to stocks and bonds from public companies. But the investment world is changing. Private companies, which were once accessible only to institutional investors and the very wealthy, have grown significantly in importance. This raises a big question: should these more expensive and less transparent private investments now be offered in workplace retirement plans? The debate is heating up as proponents of the private investment market argue for a more democratic approach to investing. In fact, according to reports by the Wall Street Journal, there is even talk that former President Donald Trump might ease the process through an executive order. If this order is issued, it would likely direct the Department of Labor and the Securities and Exchange Commission to advise employers on how to incorporate private investments into 401(k) plans. Although current laws do not prevent plan administrators from including such assets, many have resisted for fear that doing so could breach their fiduciary duty to provide safe and reasonably priced investment choices. Not surprisingly, this proposal has drawn sharp criticism from several lawmakers and consumer advocates. Among the most outspoken is Senator Elizabeth Warren, the ranking Democrat on the Senate Banking Committee. Recently, she sent a pointed letter along with a set of detailed questions to Empower, a major record keeper for workplace retirement plans serving about 90,000 employers, from large corporations to government bodies and non-profits. Empower had recently announced that it would offer plan sponsors the option to include private equity investments in their retirement plans. In response, Empower drew a parallel with the revolutionary introduction of the 401(k) itself. Empower CEO Ed Murphy remarked that just as the 401(k) once democratized access to the public markets, the current investment landscape, with far fewer publicly traded companies and an estimated $13 trillion in global private equity assets, demands a similar evolution. He argued that this shift is particularly important for everyday investors who want exposure to innovative or fast-growing companies but might otherwise miss such opportunities. But here's where it gets controversial. Empower stressed that the new private equity option would not be an unregulated free-for-all. The proposed solution comes with a series of guardrails designed to protect investors. Only participants with managed accounts, those overseen by professional investment managers who tailor the investment strategy based on each individual's financial goals, risk tolerance, and time horizon, would have access. Additionally, the private equity component would form only a part of a broader collective investment trust, CIT, with the remaining portions consisting of public securities. This approach, according to Empower, provides an extra layer of analysis and fiduciary oversight, ensuring that the exposure to these complex asset classes is both thoughtful and secure. Senator Warren, in her formal reply to Empower's letter, acknowledged the shared objective of helping all Americans achieve lasting financial security through responsibly managed investments. However, she remained unconvinced. In her view, Empower did not sufficiently explain how it would protect plan participants, and our overall financial system, from the inherent structural risks of private markets. Furthermore, she questioned why allowing retirees to risk their hard-earned savings in these volatile and expensive private assets would benefit anyone other than the private funds themselves. Warren also pointed out the lack of transparency regarding Empower's partnerships with private firms, its fee structures, and the incentives at play. She concluded her letter by demanding that Empower address her specific questions by Friday, July 25, 2025. And this is the part most people miss. While this debate continues to evolve, the Securities and Exchange Commission's Office of the Investor Advocate has announced plans to examine the implications of including alternative investments, like private equity and private credit, in retirement plans during fiscal year 2026. They aim to determine what these changes might mean for retail investors. What do you think? Is opening up 401(k) plans to private equity a groundbreaking opportunity to democratize access to innovative investments, or does it simply expose everyday savers to unnecessary risk? Share your thoughts and join the conversation. 2. Trump's 401k private equity expansion, retirement game changer. Imagine a game-changing shift in how Americans can grow their retirement savings, allowing 401k plans to invest in private equity. This isn't just another tweak, it's a significant move that could reshape the financial landscape. But here's where it gets controversial. Some experts argue that this could open the door to higher risks and fees, potentially jeopardizing hard-earned retirement funds. According to reports, President Donald Trump is poised to sign an executive order that would permit 401k plans to invest in private equity, a sector that has long been off-limits due to regulatory hurdles. While no specific date has been announced, the Wall Street Journal suggests the directive could be finalized soon. This decision would be a major victory for the private equity industry, which has been pushing for access to the approximately $12.5 trillion currently held in 401k accounts. This step represents the most aggressive attempt yet by the Trump administration to integrate private equity into retirement plans. For years, officials in Washington have grappled with the legal and regulatory concerns that have kept alternative assets, like private equity, out of most defined contribution plans. Traditionally, retirement portfolios have been dominated by stocks and bonds, partly because plan administrators have been cautious about investing in illiquid and complex financial products that come with higher risks. The new directive builds on previous actions taken during Trump's first term, including Department of Labor guidance that suggested plan administrators wouldn't be breaching their fiduciary duties by including private equity in their portfolios. However, this guidance was later rescinded by the Biden administration, adding another layer of complexity to the debate. Both traditional and alternative asset managers are keen to tap into the defined contribution space, seeing it as a huge growth opportunity. As institutional investors like U.S. pension funds and endowments find their investment options in private equity limited, they're turning their attention to the 401k market, especially given the current slowdown in deal-making and reduced client distributions. Supporters of the proposed changes argue that allowing 401k plans to invest in private markets would offer savers a wider array of investment options and the potential for better long-term returns. On the flip side, critics raise valid concerns about the higher risks and fees associated with private equity investments. There's worry that poor performance could expose plan administrators to increased legal liability, and that high fees might erode retirement savings. Financial advisors and money managers have been advocating for more diverse investment portfolios that reflect today's financial reality. They point out that the number of publicly traded U.S. firms has sharply declined since the 1990s, while private equity assets have more than doubled over the past decade. With fewer opportunities in public markets, many investment chances are now available only in the private sector. Opening up 401k plans to private equity could mean that everyday savers get a chance to benefit from investment opportunities that have traditionally been reserved for institutional investors. As Brian Corbett, President and CEO of the Managed Funds Association, a trade group representing the alternative asset management industry, stated, expanding access to alternative investments in 401k retirement plans will provide more Americans with the diversification and investment options needed to build wealth and save for a successful retirement. We look forward to seeing how this policy unfolds and what impact it will have on individual retirement savings. What do you think? Is this a step in the right direction, or does it pose too many risks? Share your thoughts in the comments.